If you have a taxable investment account, you're going to want to pay close attention because what we're about to cover could be one of the most important financial moves you make for 2026. We are going to turn those painful red numbers in your portfolio into a real tax refund. Let's do this. Okay, got to do the legal stuff real quick. Just remember, this is all for educational purposes. It is absolutely not financial, tax, or legal advice. You always need to talk to a qualified pro about your own situation. All right, let's get back to it. You know that feeling, right? You log into your brokerage account, you see a bunch of red, and your stomach just drops. It can totally ruin your morning coffee. You see that stock you were so excited about, now it's way down. And your first instinct is just to slam the laptop shut and pretend you never saw it. We've all been there. But here's the secret. That gut reaction is the exact opposite of how a professional investor thinks. Seriously, when they see red, they don't see a loss. They see an opportunity. They see a valuable tax asset. And today we're going to break down exactly how they turn what feels like a loss into a major win. So the best way to really get this is to picture your finances as two big buckets. Simple enough, but here's the problem. Both of these buckets have holes in them, and they are constantly leaking your money out to the IRS in the form of taxes. Our entire job today is to learn how to plug those leaks. So here are your two buckets. You've got the capital gains bucket and the paycheck bucket. The first one is kind of a slow, steady leak that comes from your investment profits. But the second one, your paycheck bucket, well, that's usually the biggest, highest pressure leak you've got. Let's talk about that first leak. Capital gains tax. This one's pretty straightforward. Every single time you sell an investment for a profit, boom, the IRS takes a piece. You can think of every winning trade you make as a new little hole springing in the side of this bucket. And then there's the big one. The ordinary income leak. This is not a slow drip, my friends. This is a high-pressure gusher, and it's coming straight out of your paycheck. And because this money is taxed at your highest personal rate, it is by far the most expensive and damaging leak that you have. So, how in the world do we stop these leaks? We need plugs. And this right here is where the magic happens. You actually create these plugs from your losing investments. By intentionally selling an investment that's down, you harvest the loss. That loss then becomes the perfect tool, the perfect plug to stop the leaks in both of your tax buckets. Okay, let's start with the most obvious use case. How do we take these plugs we just made and use them to stop that first leak, the one in our capital gains bucket? It's incredibly powerful because it's a dollar-for-dollar match. You can use your harvested losses to completely 100% eliminate your capital gains tax. So if you've got, say, $10,000 in gains from some winning stocks, but you also have $10,000 in losses from some losers, guess what? You owe zero tax on your investments for the year. It's a perfect shield. Now, plugging investment gains is fantastic, but this next part, this is where the strategy goes from being just smart to an absolute game changer. Let's talk about using those same plugs to stop that high-pressure gusher from your paycheck. So this is the big question, right? What happens if you have way more losses than gains? You've already plugged up your capital gains bucket completely, but you've still got these valuable plugs left over. What do you do with them? Well, this is where you get a direct cash boost back from your paycheck. Before I even explain how this works, just look at this number, $1,440. That is the actual guaranteed tax refund an engineer got from a stock that was losing him money. This isn't a theory, it's a real result. Let me show you exactly how he did it. So let's meet David. He's got a $6,000 paper loss on some tech stock. Now, instead of just ignoring it, he sells it to harvest that loss. Now watch this. The IRS lets him take $3,000 of that loss and use it to directly reduce his taxable salary. He's in the 24% tax bracket, so that's an instant $720 back in his pocket at tax time. But he's not done. He still has another $3,000 loss left over. That amount just carries forward to the next year, where he does the exact same thing for another $720 refund. That is how a $6,000 paper loss magically becomes $1,440 of cold, hard cash. Okay, I know this sounds amazing, almost too good to be true, right? Well, there's one giant trap set by the IRS, and it catches almost every amateur who tries this. If you don't know this rule, your entire strategy is completely worthless. It is called the wash sale rule, and it's brutally simple. You can't just sell a stock for a loss on Monday to get the tax break and then buy the exact same stock back on Tuesday. If you buy back the same or a substantially identical security within 30 days, before or after the sale, the IRS says nope, and your deduction is disallowed. And trust me, your broker reports all of this to the IRS automatically. There is no hiding it. So does this mean you have to sell your loser and then sit on the sidelines in cash for 31 days, potentially missing a huge market rally just to get your tax break? Absolutely not. No way. This is where we pull a page directly from the professional's playbook to legally and elegantly sidestep the entire trap. The move is called a proxy asset swap. It's a 3-step dance. Step 1. You sell your losing investment. Let's say it's the Vanguard S&P 500 ETF, symbol VOO. Step 2, you immediately take that cash and reinvest it into a similar but not legally identical asset. For example, you could buy the Vanguard Total Stock Market ETF, VTI. They're both big index funds, but they track different indexes, so they're not identical. Another classic example, selling Lowe's and immediately buying Home Depot. The result? You lock in your tax deduction, but your money never ever leaves the market. This is the whole ballgame. Okay, you get it now. You see the why and you see the how. Let's put this all together into a concrete, actionable playbook that you can actually use for your 2026 taxes. And you've really got 2 ways you can go about this. You can either do this yourself manually, or you can have a service do it for you automatically. The manual path is totally free, but it takes discipline. You have to remember to log in and do it, usually around December. The automated path, like with a robo-advisor, will cost you a small fee, but their algorithms are looking for these opportunities for you every single day. For high earners making regular deposits, the extra tax savings from daily harvesting can often be way more than the small fee they charge. Now, if you want to go the DIY route, here is your 7-step checklist. Step 1, and I cannot stress this enough, this is only for a taxable brokerage account. Do not do this in your IRA or 401k. Step 2, find your losers. Step 3, figure out how much you need to sell to hit your goal. Maybe it's $3,000. Step 4, sell them before the end of the year. Step 5, immediately buy your proxy asset. Step 6, set a calendar alert and wait a strict 31 days before you even think about buying back what you originally sold. And finally, Step 7, your broker will send you Form 1099-B to make claiming the deduction on your taxes super easy. So I will leave you with this one question to think about the next time you log into your account and you see that sea of red. After everything we've just talked about, are those losses actually a problem you should ignore? Or are they just a tax refund, sitting there in disguise waiting for you to come and claim it?